Hi there, welcome back to Finance Talks My Robot family. In today's video, even if you don't have a lot of money or a finance degree, you should start investing. Furthermore, you should begin investing as soon as possible, particularly if you want to retire comfortably. But where do you begin when it comes to investing? I'll show you how in this guide. It's a lot simpler and less costly than you would expect. Why should you begin investing? Why should you invest in the first place? Isn't it dangerous? Isn't it better to keep your money under your bed or in a savings account? Though investing entails some risk, it is much less risky than holding money under your mattress. Aside from the obvious danger of having all of your money stolen or lost in a crash, the unseen forces of inflation can erode the value of your money over time. The estimated annual rate of inflation is about 3%. This means that prices rise by about 3% per year. This may not seem to be a significant amount, but that 3% adds up over time. Even if you continue to gain more money, if you hold all of your money in cash, it will easily lose value. But what if you put your money in a savings account and gain interest on it? According to the FDIC, the average interest rate on savings accounts in the United States is about 0.9%. Even if your bank provides 3 times that, it won't be enough to keep up with inflation. This is why simply putting money in a savings account would rarely provide you with enough income when you retire. Inflation will continue to erode the value of your savings, no matter how much you invest. You must begin saving now in order to have enough money to survive on when you retire. What exactly is investing? So, what exactly is it that you're investing in? That's a big question, but investing is simply buying something with the expectation of it increasing in value. From a plot of land to an antique bidet, this might be anything. Stocks and bonds. A beginner's guide to investing. When most people talk about investing, they're usually talking to stocks, shares, or a combination of the two. A stock is simply a unit of equity, or share, in a company that you can buy and sell. When you invest in stocks, you expect that the value of the shares you buy will rise over time, allowing you to sell them for a profit. Bonds, on the other hand, are a form of loan that governments, and sometimes corporations, use to fund projects. When you buy a bond, you're simply lending money to a government or company in the understanding that they'll repay you with interest plus the original amount borrowed. Bonds are also less volatile than stocks, but their future benefit is also smaller. So, do you put your money in stocks or bonds? Stocks have the advantage of potentially making you more money, but they're also riskier than bonds because the company's stock could lose value or even go bankrupt. Bonds are a much safer investment, but they also have a lower return potential. As a result, it's a good idea to invest in both to spread your risk. This is referred to as diversification. ETFs are stock and bond baskets. Investing in a variety of stocks and bonds is safer than investing in a single stock or bond, but it is still risky. You could lose a lot of money if all of the stocks in your portfolio, your list of investments, perform poorly. Furthermore, if you just invest in a few firms, you risk missing out on future profits when other companies do well. Instead, it's better to spread the funds through a variety of stocks and bonds. As a result, the stock and bond output averages out to a higher overall return. Fortunately, there is a simple way to invest in big groups of stocks and bonds without having to buy them all separately. It's known as an exchange-traded fund, ETF. A fund is a grouping of various stocks and bonds, often hundreds or even thousands. The term exchange-traded refers to the fact that the fund is traded on a major stock exchange. ETFs have a number of benefits in addition to providing a lot of diversification. ETFs are inexpensive. Buying an ETF does not require thousands of dollars, making them an excellent option for a novice investor with limited funds. ETFs are hands-off. You don't have to do a lot of homework or take the time to purchase stocks and bonds individually. Automating ETFs is easy. You can set up automatic deposits from your bank account for certain investment accounts, the service you use to purchase ETFs. You'll be able to contribute consistently without having to think about it. You can even do it for free with M1 Finance, our choice for the best beginner investing platform. Investing in different ways. This was a high-level summary of the types of investing in which you can get started without a lot of capital or advanced knowledge. There are other worthwhile forms of investing, such as real estate investing and mutual fund investing, But we won't go into them in this article because they typically take more capital, time, and analysis. A 3-step strategy for getting started with investing, even without money. Now that you know how investing functions in principle, let's talk about how to get started. 1. Tax advantages. Contributions to your 401k are tax deductible, which means they will lower the amount of income you pay taxes on, potentially placing you in a lower tax bracket and thus lowering your income taxes. You will contribute up to $19,500 to your 401k in 2021, which will result in substantial tax savings. 2. Unrestricted funds. Many companies can match your 401k contributions up to a certain level. If your employer matches your contributions, you should still contribute at least as much as your employer would match. This is essentially free money, don't throw it away. If you're unsure whether or not your company matches donations, inquire with the individual in charge of employee benefits. What if the company doesn't have a 401k or other retirement plan? In this scenario, we suggest that you open an individual retirement account, IRA, and contribute the maximum amount possible to it. Employer matching isn't available for IRAs, and the annual contribution cap is lower, $6,000 as of 2021. Contributions to an IRA, on the other hand, are tax deductible. 3. Don't tamper with your assets. The way movies depict investing can give you the idea that you need to keep a constant eye on the stock market and be ready to change your investments at any time. While this is important for skilled investors like day traders, it is a waste of time for ordinary investors like you and me. Keep in mind that you're making a long-term investment. This means you shouldn't be concerned about what happens in the market over the course of a week, month, or year. It makes no difference whether the returns are low or high right now. You're just interested in average returns over decades. When the market is performing poorly, it can be tempting to withdraw all of your funds in order to prevent losing capital. This is a lure you must resist. If you become enraged when the market is performing badly, you will be unable to invest regularly. And it is continuity that allows this investment strategy to succeed. You now have all of the necessary details to begin investing. However, I'd like to point out a few common investment blunders to avoid so you don't lose a lot of money. 1. Seeking investment advice from family and friends. A well-meaning friend or family member will advise you at any stage in your life that you must invest in such and such company or asset because it is a once-in-a-lifetime opportunity. You should respectfully disregard anyone who tells you this. It's possible that your Uncle Joe or college roommate discovered a successful investment, but it's highly unlikely. Instead, stick to your tried and true investment approach. 2. Attempting to outperform the market. It's tempting to believe that if you do enough homework, you will find some hidden investment opportunity that will cause you to beat the market, earn higher than average returns. However, it turns out that almost no one, even skilled investors, can beat the market. 95% of successful fund managers struggle to outperform the index, according to data from S&P Dow Jones Indices. And keep in mind that these are experts who have studied finance for years and spend hours per day reading financial reports. Why do you expect to beat the market if they can't even beat it half of the time? You're better off simply investing in ETFs rather than obsessing about the right investment strategy. 3. Attempting to become rich quickly. I know I've said it before, but it bears repeating: invest for the long term. While the right stock trades can make you a lot of money in a day or even an hour, it's also incredibly complicated, volatile, and a perfect way to lose a lot of money quickly. Plus, don't you have more important things to do than stare at stock market graphs? Stick to the dull, passive investing we describe in this article unless you're a day trader. Check out our guide to making an additional $1,000 a month if you're looking for creative ways to make money in the short term. 4. Withdrawing funds while the market is underperforming. I've said it before, and I'll say it again: don't panic if the market falls. Since you're a long-term investor, you're unconcerned with short-term volatility. The sooner you begin saving, the more compound interest will benefit you. Now is the time to start putting your money to use. Make the most of any retirement package offered by your employer. Yesterday was the perfect day to start saving. However, you can begin right now. So that's it for today's video. I just wanted to say, thank you so much for watching. If you're still watching, you're an absolute legend, and remember to smash the like button and the subscribe icon so you get the latest updates when we post the new videos. See you soon.